Good morning, everybody. My name is Tracey Turner, and I'm a director within Lentil's healthcare team. I'm going to be explaining some of the uses of limited companies and also some of the disadvantages that also need to be taken into consideration. So there is some potential for partners to put some of their practice income through a limited company, as long as that income is non-NHS work. So that could be, for example, research fees and medical reports. Partners who also do a lot of outside income away from the partnership may also wish to form a limited company to put private work into, such as locum income. In addition to this, properties can be bought through a limited company to let out. However, we would not recommend this unless this was seen as a long-term investment. One of the advantages of a limited company is that your personal assets are protected. So if something does go wrong with the limited company business, any creditors cannot go after your personal assets. They can only go after the assets within the limited company. So it's quite reassuring to know that your personal home is protected. One disadvantage of a limited company is that the income put into it is not pensionable. However, in some circumstances, this may help because individuals can each have pension growth of up to £40,000 per annum. And once their pensionable income exceeds £200,000, this annual allowance of £40,000 is reduced on a sliding scale down to a minimum of £4,000. So to preserve the annual allowance, some partners may wish to hive off some of their income and put it through a limited company. If the annual allowance is exceeded, the partners could be due a tax charge unless they have completed scheme pay forms. The lifetime allowance is currently 1.73 million, and if partners are finding their pension pots are approaching this value in total, again, they may wish to use a limited company to avoid their pensions growing so quickly. If they do exceed the lifetime allowance, they may be stung for a tax charge of up to 55%. So with a limited company, there are different requirements than for the normal set of partnership bank accounts. So the accounts need to be filed every year at Companies House, and currently this is a simplified balance sheet. However, there has been a recent Companies House reform, and we understand that in the future, profit and loss account will need to be filed at Companies House. So currently, the balance sheet has to be filed within 9 months after the year end to avoid any penalties being incurred. It's also important to realise that all this information is available for public inspection free of charge on the Companies House website. So in addition to the accounts, a confirmation statement, so this lists the directors' names and addresses, the registered office of the company and the shareholders. And this has to be sent to Companies House every year and again is available for public inspection. So some of the directors use Lentil's office address as their service address, and this is to prevent their home address being publicly shown on Companies House website. The company taxation. Currently, the corporation tax rate is 19%. However, from the 1st of April 2023, things are changing. And for trading profits up to £50,000, the corporation tax rate is 19%. For company profits over £250,000, the corporation tax is rising to 25%. And for profits in between these two levels, they will be taxed at 25%, and they may be eligible for some marginal relief as well. So a higher rate taxpayer will pay tax and national insurance at 43.25%. So that makes the company taxation look really attractive. But unfortunately, that's not quite the whole story. So each individual can receive dividends of £2,000 per annum without paying further tax. A basic rate taxpayer, so that's with income up to £50,270, will pay dividend tax at 8.75%. A higher rate taxpayer, so that's with income from £50,270 up to £150,000, will pay dividend tax at 33.75%, and an additional rate taxpayer, so that's with income over £150,000, will pay dividend tax at 39.35%. So you can see that as soon as an individual is a higher rate taxpayer, the dividend tax jumps right up. And that's in addition to corporation tax that's already been paid. So one way to avoid this higher rate of dividend tax, if it is possible, is to leave the profits within the limited company until the partner retires or their income reduces, to avoid this high dividend tax. If the limited company bank account then builds up quite a lot of funds, this can be invested in perhaps a share portfolio or a buy-to-let property, so it's not just sat there doing nothing. If individuals find that their taxable income is approaching £100,000, a limited company is again useful to help preserve the personal tax-free allowance, which is currently the £12,570. So once income goes over £100,000 up to approximately £125,000, the tax-free personal allowance is gradually withdrawn on a sliding scale to nil. So this means profits within these levels are effectively taxed at a rate of 63.25%. So a really high level of personal tax. So capital allowances. So all limited companies, partnerships and sole traders can claim capital allowances when they purchase fixed assets. And this is deducted from their profits to help reduce tax payable. At the moment, we've got the annual investment allowance. So this is where 100% of the cost of the asset can be relieved against profits in the year of purchase. Limited companies also have the super deduction, 130% first year allowance for qualifying plant and machinery. So if, for example, a piece of equipment was purchased for £10,000, if this was purchased set against your partnership profits, the £10,000 would be deducted from partnership profits, and then the tax is calculated after this. So for a higher rate taxpayer paying tax at 43.25%, the tax relief would be £4,325. So if the same piece of equipment was put through the limited company, 130% first year allowance could be claimed. So the limited company profits would reduce by £13,000. But as the tax rate for a limited company is 19% and much lower than a higher rate taxpayer, the tax saving for the limited company would be £2,470. Therefore, it would be still beneficial to put this piece of equipment against your partnership profits, as you would obtain more tax relief this way. So to claim the super deduction 130%, the expenditure has to be incurred between the 1st of April 2021 to the 31st of March 2023. And items that qualify would be computer equipment and servers. We've also got office chairs and desks, electric vehicle charge points and solar panels. Company structure. So it's really important to set up the limited company in the correct format from the outset, and that is why we would always advise to take professional advice before setting up the limited company. If changes are needed to the company structure, once it's started to trade, there will be value in the limited company. And then if shares are transferred, capital gains tax could be incurred. So just make sure you get it right from the outset. A really useful structure are the alphabet shares. So this is when partner 1 has the A shares, partner 2 could have the B shares, partner 3 have the C shares, and so on. And what's useful about this is that each partner can take dividends at different and totally unrelated levels to the other partners. So if, for example, partner 1 had done a huge amount of work in the limited company compared to the other partners, that partner could take much higher dividends. So that makes it much fairer. And this company structure can also be used for a limited company which has shareholders owned by family members. So the partner could have the A shares, the spouse could have the B shares, and the children could perhaps have the C and D shares. So that's fine for children over the ages of 18 because they can own the shares in their own right. And if these children are perhaps at university, they may have their tax-free personal allowance of £12,570 plus the £2,000 dividend allowance. So this means they could have £14,570 worth of dividends a year without paying any personal tax. And so this would be a good contribution towards university fees and living costs. With children under the ages of 18, unfortunately, if parents buy these shares, then the dividends are taxed on the parents themselves. So one way to avoid this is to have grandparents buying the shares, and there needs to be a clear paper trail of the grandparents paying money into the limited company bank account to buy these shares on behalf of the grandchildren. The grandparents can then set up a bank account as trustee for the grandchildren, and dividends can be paid into this. And once again, these children under the ages of 18 will have their tax-free personal allowance and the dividend allowance, so they would also be able to have £14,570 of dividends each year without incurring any personal tax charges. So again, that could be really useful for school fees or school trips. There is a downside to this, unfortunately, in that once the children reach the age of 18, they have full control of their shares and also full control of the bank account. So if there is a large amount of money in this bank account, they may not be mature enough to sensibly manage this money. In the future, your children could get married and possibly divorce, and you may fear loss of control of your company. So that's why we would always advise that a shareholders agreement is set up by a solicitor, and then they can prepare for any unforeseen events in the future. When we set up the limited company, we can also include preemption rights. So this would give existing shareholders the opportunity to buy any shares first if they're being sold in the future. If the dividends are not needed by the children, they can be left in the company as a family loan. So then interest can be charged on these loans, and this interest will be included in the limited company accounts. So this will help to reduce the limited company profits and help to reduce the corporation tax payable. In addition to this, each child, if they're a basic rate taxpayer, can receive £1,000 of interest tax-free. Higher rate taxpayers can receive £500 of interest tax-free. So that's another really useful method of extracting funds from the limited company and avoiding a personal tax charge. If this is done, there is additional paperwork that needs to be sent to HMRC, so there would be additional administrative work involved. The limited companies for PCNs. So going forward, we do think that this will become much more common. However, at Lentils, we're not currently setting up limited companies yet. We are waiting for definite confirmation that staff can stay within the NHS pension scheme, even if the PCN is in the limited company. So I hope that's given you some insights onto the uses of limited companies. And if you do have any questions, please let me know.